Good morning and good afternoon. My name is Margaret Salazar from the Office of Multifamily Housing Programs, and I'm pleased to welcome you to the ongoing series of trainings for the Low-Income Housing Tax Credit Pilot Program. Today's session is Assisted Housing under the Low-Income Housing Tax Credit Pilot. We'll be covering issues related to assisted housing, including Section 8 rent increases, prepayments, waivers, and other asset management functions. And we'll also be talking about some of the legal issues related to the pilot program. We will hear from all the panelists today, and then there will be an opportunity for us to take your questions. So please do send in your email questions to mark.c.wiesendanger@hud.gov. I'd like to take this opportunity to introduce today's panelists. To my immediate left is Eric Ramsey, the Director of the Program Participation and Policy Division in the Office of Asset Management. To Eric's left is Diana Reed, a Housing Program Manager also in the Office of Asset Management. To her left is Gloria Burton, also a Housing Program Manager in Asset Management. And finally, Stan Houle, Program Manager in the Office of Housing Assistance and Grant Administration. I'd like to start today's presentation with a general overview of assisted housing issues. Again, after you hear from all the panelists, there will be an opportunity for us to take your questions, and then we'll transition into the legal portion of today's presentation. So let me talk a little bit about some of the goals for assisted housing under the pilot program. As you've heard in some of the previous sessions, assisted housing is one of the main focuses of the tax credit pilot program. And really what the pilot is intending to do is to facilitate the preservation of assisted housing. That includes drawing new equity into aging projects that might have maturing loans or expiring Section 8 contracts. And it also includes being able to use that capital to make needed project repairs for many of these properties that are 30 or 40 years old and need significant capital improvement. The other goal that we have for the pilot program is to really pilot ways to streamline the reviews and loan approvals for assisted housing projects. That includes, we're trying out different ways to better integrate the asset management and development functions, and to really focus on the risk-based underwriting of Section 8 properties as a way to facilitate and streamline the approvals of refinancing of Section 8 properties. So assisted housing really has some unique features, which is one of the reasons why we chose it as a program type for the Low-Income Housing Tax Credit Pilot Program. So projects that are assisted with Section 8 contracts, we believe are inherently lower risk than market rate projects or tax credit projects that do not have Section 8 assistance. So for the pilot, what we're talking about is housing, just as a reminder for folks, that has 90% or more of the units assisted with a project-based Section 8 HAP contract. Now, because that subsidy is tied to the project units, it is inherently lower risk because there's an ongoing flow of subsidy to the project. What that means is that these projects tend to have lower vacancy, and many of them actually operate with waiting lists. So again, you don't have as much occupancy risk. Typically, as you'll hear in much more detail later, the rents at these projects are akin to market rents, either set by market or budget-based processes that you'll hear about more later today. So for the tax credit pilot, what we're talking about in terms of underwriting is to really try to address some of the underwriting challenges for assisted housing. We believe that assisted housing, because these are HUD-assisted assets, these should be easier to underwrite, but unfortunately, historically, they've been pretty complicated to underwrite, and we're trying to unravel some of that using the pilot. So a couple of different things I wanted to focus on for you today. First is that one of the complications is that for Section 8 contract properties, the rents are actually set through the Section 8 program. They're either set by a budget-based formula or by market comparables. And then rents are adjusted either by a budget or an OCAF. And there are also market tests on those rents, depending on which renewal option an owner is choosing. Often with the FHA insured loan applications, the income estimates are coming directly from the appraisal that's required for the loan program and the MAP appraisal methodology, which does not account for the different rent setting mechanism of the Section 8 program. So what you end up with, of course, and if you've done these loans, you've experienced this, is that often there's a conflict between the rents that are set through the underwriting process, through the appraisal and the lender's analysis of that appraisal, and then the rents that are set through the Section 8 program, either through the market rent function of the rent comp study or the budget-based function. And that, of course, creates sort of a coordination problem between the development and the asset management sides of the house at HUD. And it becomes this sort of what we call the chicken and egg problem. Are we setting the rents based on the underwriting? Are we setting the rents based on the Section 8 program and then using them in the underwriting? Which rent setting function comes first? And I know from personal experience that this can cause significant delay when you're trying to review and underwrite and approve an FHA loan, because you're really trying to nail down what those rents are and what that does to the income and, of course, the loan sizing. So what we've done for the pilot is to try to address some of these complications. So the first thing I wanted to mention is the pilot application really needs to reflect the continuity between the rents that are used in the underwriting and the rents that are being proposed in the Section 8 contract that may be requested by the owner. So just to kind of back up a little bit, when you're looking at what's required under the pilot for these assisted projects, we actually are requiring the lender to submit with the FHA loan application a copy of the Section 8 HAP contract renewal request that has been submitted by the borrower prior to the tax credit application submission. So we want to actually see that the lender has seen that contract renewal request, has seen the rents that the borrower is requesting, and has had a chance to think about those rents in relation to the loan application. We also want to see a copy of the rent comparability study that is being utilized for the Section 8 rent setting process. As a general rule, we want to see that the underwriting, the rents that are used in the tax credit pilot application underwriting, we want to see those rents are aligned with the rents that the borrower is requesting in the HAP contract. If that borrower is requesting a rent adjustment, essentially a rent increase as part of the renewal process, we want to see that that FHA application includes the rents that are being requested by the borrower. Now, we have a couple of examples actually of some of the earliest deals that we've seen come in through the pilot program, where the owner decided that they actually, and working with the lender, they actually did not need to get the rent increase in order for the FHA loan to pencil out. So they were able to actually underwrite the loan using the current rents. That's great too, that's fine too. Often that's not what we're seeing out there. We're often seeing that the owner does need to get that rent increase. So we want to see that the lender has taken a look at that rent increase and is taking that into account when they're doing their underwriting. And often we see that those rents just don't match up, and it can cause a lot of delay. So if you see the slide on your screen, you'll see that there are a number of steps here. So I'll try to walk you through what we're trying to do with sort of the process engineering to make this process work out. And again, it's the process of aligning the Section 8 contract renewal request with the loan underwriting and loan sizing. So the first step would be the borrower actually submits their Section 8 renewal request to HUD and the PBCA as required under the Section 8 renewal guide. That may include a rent comp study. This doesn't change any of the processing of the HAP contract renewal. And again, you'll hear more later today about some of those requirements, but that step of the owner actually preparing and submitting the Section 8 renewal request, that should come first. If the borrower is submitting a budget-based rent increase, then their renewal request should include the new debt service that they're anticipating as part of the FHA loan. And that's sort of the chicken and egg problem. But again, we want the lender and the borrower to be having a conversation, estimating what that new debt service might look like and including that new debt service in their budget-based rent increase request. After submission of the renewal request, then the lender is going to incorporate the requested rents into their FHA loan underwriting. The lender would then submit, along with their FHA loan application, again, they submit a copy of the HAP contract renewal request and the rent comparability study, if that's required under the renewal option that the borrower is using. They're submitting that to the HUD office along with the pilot loan application. Now, the lender can use lower rents in their underwriting than the rents that the owner is requesting, but they can't use rents higher than what the borrower is asking for in their Section 8 HAP contract renewal request, which makes sense because this will be the actual contract rents that the project will be experiencing, and we don't want the underwriting to be higher than that level. If the owner is requesting a budget-based rent increase, as I mentioned before, The borrower is going to be estimating that new debt service and including that in their initial budget-based rent request. But then at some point during the firm commitment processing, HUD and working with the lender is going to be finalizing the loan sizing, and will know at some point the final debt service, typically when the firm commitment is issued. So then the borrower would go back and include the new debt service, the real actual debt service, in that budget-based request. And so then the rent increase can be approved. So what are the benefits to this approach? Now, it still sounds pretty complicated, right? But if you follow those steps I just went through, it should help to cut down on some of the misconceptions and misunderstandings and the back and forth, both within HUD, asset management and development, between HUD and the lender, and then between the lender and the borrower. Hopefully we have a pathway now to kind of cut down on some of that back and forth. So we're hoping that a lot of the coordination is between the lender and the borrower, and that is happening before the lender submitting the loan application, so that when HUD sees it, we have the benefit of all of that work that's been done up front between the lender and the borrower. As a general rule, what we've said in all of our guidance is that if the rents in the FHA loan application do not match the Section 8 rent request, we're going to go ahead and reject that application. Again, it cuts down on weeks of back and forth to try to nail down what those rents are. Now, that's a general rule. There might be some cases where the lender might be able to make a case for why the rents don't match up and why they're using different rents. That's fine, but we want to know that the thought has been put into it and that it's a deliberate decision, underwriting decision by the lender. The other benefit to this approach is that, and all of what we're trying to do here with the pilot, is really engaging asset management early. We really want the development designated underwriter at HUD to confer with asset management early on the borrower's performance, the needs of the projects, and expenses and income. And what that's really about is that we want asset management to be involved not only on some of the kind of technical steps for approving rent increases and approving some of the waivers and prepayments, but actually to be integrated as a partner here to kind of give the development side of the house some important information about what really the plan is for this property, what the property needs, and what some of the risks are. Too often what we've seen is that assisted housing is sort of treated as if it's market rate housing when we do the underwriting work. And what we really believe is that, for example, the valuation portion of the underwriting review that HUD is doing isn't as critical here for the Section 8 properties in terms of doing a site review to look at comparables. What we really want is some critical thinking about the repairs that are needed, the capacity of the borrower, and some of that other really key information that asset management has. And that's why we're asking the designated underwriter to do a desk review and not to focus on doing having the appraiser go out and do the typical valuation site visit that's been required by the MAP program. Again, the designated underwriter is encouraged to coordinate with asset management. If possible, asset management could attend the site visit as well. But we don't want our folks to spend their time going through things like rent rolls and occupancy history that's really critical for market rate properties. But since that information is available in IRMs, it's not as key to really making strong risk-based underwriting decisions for assisted housing properties. So with that, I will go ahead and turn it over now to my colleagues. And the first step will be Eric Ramsey, who will be talking about 2530s and other issues related to policy and participation.
Okay, thank you, Margaret. Just by way of introduction, along with me, with my colleagues here, Diana Reed's going to be speaking to you about the prepayment processing, and Gloria Burton's going to be speaking to you about the special approvals for prepayment. And we have Stan Hill who's going to be speaking to you about tax credits pilot, as well as the Section 8 contract renewal. As most of you know, in this process, 2530 approval is very important. And to make sure that this process is complete in a timely manner, we want to make sure that the 2530 application is approved. What that means is that the owner has signed to the certification that the information is correct, their participation is listed on the form, and the form is dated. One of the issues that can be a red flag in the approval process is outstanding flags. If the owner has not submitted financial statements, or they have a below 60 physical inspection score, or the management and occupancy review rating is unsatisfactory or below average, that could be a concern. So you need to work with the owners or the management agents to make sure any outstanding flags are resolved. You should contact the local field office that has jurisdiction over the property to make sure that those flags are resolved timely, so that when it's time to approve the loan, those issues have been resolved. There are certain flags that have to be raised to the headquarters level. For example, if there's an issue concerning default, foreclosures, bankruptcies, suspensions, or debarment, the owner should submit the documentation to the local field office explaining exactly what has gone on to cause those issues. And the field office should send that information here to headquarters. And it would need to be reviewed by a review committee to make sure that approval, if granted, for this transaction is granted so that it can be moved forward. That's a quick and dirty overview of the 2530 process. You can refer to Handbook 4065.1, which is the previous participation handbook. It provides information on the issues that I've just discussed, as well as 24 CFR subpart H, which provides guidance on the 2530 process. Now I'm going to turn it over to Diana Reed. She's going to speak to you about the prepayment processing.
Thank you, Eric. My name is Diana Reed, and I will be going over the prepayment processing submission requirements. For an FHA-insured mortgage, the lender must submit the Form HUD 9807 electronically to Ronald McDowell, who is the Chief Multifamily Insurance Operations Branch, to the attention of Charmaine St. Rose at the following email address: charmaine.st.rose@hud.gov, or fax the information to her at 202-401-3246. Any questions relating to the preparation or submission of the Form HUD 9807 should be directed to Ms. Rose at 202-402-2029. The written request to prepay a HUD-held mortgage should be submitted to Deborah Courtwright, who is the Chief of the Multifamily Note Servicing Branch, to the attention of Pat Tauber at the following email address: Multifamily Notes Servicing Branch at HUD.gov, or by fax at 202-619-8408. Questions relating to the submission or written request to prepay a HUD-held mortgage should be directed to Pat Tauber at 202-402-2772, or Deborah Cartwright at 202-402-2753. The request to submit a 2028 direct loans are submitted directly to the local HUD field offices or the program center, which has jurisdiction over the property, for review and recommendation for approval to HUD headquarters asset management. Indicate on your form that the prepayment request is going to be a tax pilot program. You have 120 days for us to process the request, so make sure that everything is in compliance and up to date so we can process the request in a timely fashion. Prepayment processing for the mortgage notes that contain prepayment lockout restrictions may be approved for prepayment no earlier than 30 days prior to the expiration of the prepayment lockout end date. Lack of owner compliance with outstanding HUD policies, procedures, regulatory or statutory requirements can cause delays in issuing approval of the request to prepay. If it's determined that the request for prepayment is incomplete, the local HUD office is notified of the deficiencies. If the deficiencies are not resolved in a timely manner, the request to prepay loans may be delayed. If the lender or the local HUD office will be notified of the terms and condition of the prepayment approval. There are 9 HUD offices that are under the tax pilot program. Gloria Burton is one of the contacts, and Kimberly Britt is her backup. The offices that they will be servicing is Atlanta, Los Angeles, San Francisco, Denver, and Detroit. I will be servicing, and my backup is Isabella Cabot-Stock for the following offices: Boston, Chicago, Fort Worth, and Seattle. If you cannot contact the people that are listed for your offices, you can contact any of the people that I just mentioned in the slides. Just for the pilot program, please indicate on the prepayment request that these prepayments are for the pilot program only. Any prepayments other than the pilot program will still be submitted to your local HUD office, and your regular contacts, which is the program center, which is the housing program center, will still process your requests. The housing project managers, I'm sorry, will still process the regular prepayment requests. Gloria Burton will present the special approvals on prepayments. Gloria.
Thank you, Diana. My name is Gloria Burton. I'm a housing project manager in the Office of Asset Management. The notice for the tax credit pilot says that a point of contact will be designated by asset management. I am that designated point of contact for the tax credit pilot. Diana Reed will serve as the backup, and we also have 2 additional staff in the Office of Asset Management that will assist Diana and myself with these properties that are designated for the pilot. Those 2 staff being Isabella Cabot-Stock and Kimberly Britt. Today I'm going to go over with you some of the nuances, I'm going to call them, that may be associated with assisted housing projects. First, I will start with the Section 236 projects. I will let you know that the Section 236 decoupling notice has gone through departmental clearance and is anticipated for publication very soon. Until such time as this notice is published, you should continue to follow the guidance containing Outstanding Housing Notice 2008. One of the other nuances for Section 236 project becomes excess rental income. Excess rental income is due and payable at the time of the prepayment. For those owners who have outstanding receivables, you folks there in the field office should be working with the owner to collect the receivables and or the reports. If in fact the owner chooses to enter into a repayment agreement, you should be working with that owner now to you should be working with that owner now to enter into that repayment agreement. And just as a reminder, all excess income receivables and excess rental income reports are to be submitted to www.pay.gov. If there are any questions regarding excess income or any other owner deficiencies for these pilot properties, now is not too soon to contact either myself, Diana Reed, Isabella Cabot-Stock, or Kimberly Britt. The sooner that we know about any deficiencies or any corrective action that needs to be taken before we can get to a prepayment approval, the sooner the better. I will move into use agreements. For some of the assisted housing projects, those projects may currently be encumbered by an existing use agreement. Any requests for changes or amendments to the existing use agreement require a recommendation from the local HUD office to Mark Van Kirk, Director, Office of Asset Management. And I need to say that any request for a waiver of any type needs to be submitted by the field office to the Office of Asset Management in a timely manner, given the time frame for which we have to process the prepayments and get an approval back to the lender and a notification back to the field office. I will move to the flexible subsidy program now. The flexible subsidy program consists of 2 components: the operating assistance program as well as the capital improvement loan program. The department has in place Housing Notice H1105 that deals with deferment of repayment of flexible subsidy operating assistance loans. If in fact you become aware that an owner of a property who is participating in the pilot chooses to defer repayment of the flexible subsidy operating assistance loan, you folks there in the field should be working with the owners now to ensure that a recommendation comes into your office and then submitted to Mark Van Kirk, Director, Office of Asset Management. We cannot press too many times the need to submit those requests to us as soon as possible. And if there are any issues that need to be resolved and you need headquarters assistance during the processing of these applications to defer repayment, feel free to contact one of the 4 points of contact. And our contact information is provided in the slideshow, and these slides will be made available to you all there at a later date. The capital improvement loan may not be deferred beyond the mortgage original maturity date. So if there are any questions that you have regarding owner deficiencies, please feel free to give myself, Diana Reed, Isabella Cabistock, or Kimberly Britt a call. And just a couple of other points. As Diana expressed, the prepayment checklist, we asked a myriad of questions on that prepayment checklist, and we need for those questions to be answered very clearly and in their entirety. So by the time the prepayment gets to us, we can issue a timely approval back to the field office and back to the lender. There are links to the references that I've mentioned. The Section 236 excess income reporting notice is a link. There is a link for the Section 202 notice, Housing Notice 2012-8. There is also a link for the 2530 rules and regulations. And there is also a slide that provides the contact information for all of us in the Office of Asset Management that will be assisting you with processing of any asset management issues that may surface during the pilot. And on that, I will pass it off to Stan Hool. Stan knows that I have an issue with pronouncing his last name. I am passing it off to Stan, who will do all of the work.
Thank you, Gloria. I knew you were going to do that to me. Let me catch us up here. I kind of feel like a bit of an orphan because Eric, Diane, and Gloria all work for asset management. And for the waiver requests that are through asset management, they go to Mark. However, when we're talking about the Section 8 renewal guide and changes or waivers that are going to be submitted to that program, those need to come to the Office of Housing Assistance and Grant Administration to Kate or Catherine M. Brennan. We'll mention that again in a few minutes, but just wanted to alert you to that. Wanted to talk a little bit about the Section 8 contract renewals, because the Section 8 contract renewals, our policy is in the Section 8 renewal policy guide, which can be found on the website. There are 6 renewal options, but today we're going to kind of focus on 2 of those and then highlight this other item, which is called the Capital Repairs and Transfer Program. Option 1 is what's called markup to market, and many of you probably already know the details to these, but this is kind of a little bit of a refresher. Option 1 is markup to market. Option 2 is markup to budget. Now, if an owner who's going through the tax credit program wants to simply go through markup to market or markup to budget without any special conditions placed on it, then there's really no need for any additional action to go through. However, if they want to use this thing called the Capital Repairs and Transfer Program, then there are some additional issues that we need to talk about a little bit. Chapter 15's major benefit is something that's called after rehab rents. And basically what after rehab rents, the long and the short story is that if you are participating in Chapter 15, an appraiser can undertake a rent comp study and determine two sets of market rents for that project. They can look at the project as for example, a 30-year-old project that hasn't had a coat of paint in 30 years and determine what that market rent would be. But more importantly, they would be looking at the scope of work that is proposed for the development, and then go back and do a second, not the entire study, but a second review to see what the market rents would be for the after rehab rents on that project. What's important about that is that we hope that after the rehabilitation is undertaken, that the value of the property is going to be worth more, and that will be reflected in the after rehab rents, that the owner will then be able to take to the lender and say, here's my additional income, here's my additional cash flow, and therefore I can afford a larger loan to work on this project. Now, currently in the guide, this program is only available to nonprofits, and that's where the easy part stops and the little bit more difficult part starts. In February of last year, the DAS issued a memo to the field that said that for-profit owners would be able to for-profit owners would be able to use Chapter 15. There would be no use restrictions, and the requirement for a REACT score of less than 30 would be waived. On May the 18th of this year, we issued additional instructions that discuss that no longer are we having contract extensions, but we are requiring, if you want to participate and if you want a 20-year contract, that there would be an early termination of the existing contract, the signing of a new contract for 20 years with this thing called the preservation exhibit, which would tack on at the end of the 20 years the balance for the contract that's being terminated. Also, especially for markup to market, rents would no longer be use restricted, and we'll get to a little bit more detail for that in just a minute. So what does that mean? That means that for capital repairs and the transfer program, otherwise known as Chapter 15, a nonprofit purchaser or owner can use Chapter 15 and renew under Option 2, which is markup to budget. A for-profit owner, and I emphasize owner, can also use Chapter 15 and renew under Option 1, but you have to submit a waiver to our office for permission for the for-profit owner to use Chapter 15. Last, budget-based rents for Option 2, as Margaret mentioned earlier, budget-based rents can be used not to exceed the market, and in the budget you can use the new debt service. That is the debt service associated with the transaction. If you are for-profit and you want to purchase a project, you can only renew under markup to market, but again, you can use Chapter 15 if you seek a waiver, or if the owner seeks a waiver and that waiver is recommended by the field to headquarters. The important thing there is that there are a few other issues related to markup to market that we're trying to streamline for the renewal process. You can ask for participation to use Chapter 15. You can also ask for a waiver to secure a HUD RCS that is normally part of the mark up to market process. There used to be a restriction in option 1, markup to market, that rents would be restricted to the use restrictions, but as I mentioned earlier, those restrictions were removed in May. Now, if you renew under markup to market, because there will be tax credits associated with the proposals, with the transaction, and because those tax credits will place a use restriction on the property, because there's a use restriction on the property, the project can only renew under option 1B. Now, the criteria for option 1B are a low vacancy rate, a vulnerable population served, or community support. And one of the things that we allow as community support is an allocation of low-income housing tax credits. So if a project is getting low-income housing tax credits, it's fairly easy to meet those criteria. Incidentally, of those 3 criteria, a project only has to meet one of those in order to qualify for option 1B. Let me go into a little bit of information because, again, this is another series of waiver requests that, as the other folks on the panel have mentioned, please submit those to us as soon as you can because sometimes it takes a while to do the review of these. But basically, what we're looking for in these types of transaction waiver requests are a description of the transaction, the sources and uses associated with the project, a description of the financing, either the debt financing, the equity that's going to be provided, any other state and local financing that may be involved, that type of thing. And the specific provisions that you want to be waived if you're looking at those specific provisions. As I mentioned earlier, these waiver requests come to Kate Brennan, and we will endeavor to review those as quickly as possible and get them back to you and get the approvals made as soon as possible. With that, I think I will hand it back over to Margaret.
Great. So we're prepared to take your questions now. Please feel free to email those to us. Again, the email address is mark.c.wiesendanger@hud.gov. I think you have a copy of that spelling of that. At least I hope you do, because I'd hate to try to spell it on the fly. I think we have our first question, which is, when the owner gets a rent comp study, is it at after rehab market rents? And then the second part of the question is, if yes, can the after rehab rents go into effect at closing? And before I toss this back, I think, to Stan, I just want to clarify that this is in the context of a 223F, which is a tax credit pilot 223F that allows repairs up to $40,000 per unit.
Okay,
What are your thoughts, Stan?
my thoughts are that it should be a fairly easy question because I'm asked this question about twice a week. The long and the short of it is that under normal circumstances, the after rehab rents for a substantial rehab go into effect at the time when the work is completed and you in the field office are satisfied that the work has been done. However, in some instances, under certain financing options, you can ask that the rents go into effect at closing. However, that's very tightly regulated. We look at 3 financing sources. We look at the 223F. We look at either the Fannie or the Freddie Mod Rehab program. And we also require that the owner sign a a document that allows the field office to claw rents back if, when the work is done, it does not satisfy and does not meet the criteria that started out with the increase in the rents in the beginning. So yes, it's allowed, but there are certain conditions, and you guys are then given the responsibility for examining the work to make sure that the work actually meets the scope of work and therefore comes up to what the original RCS said the conditions would justify the after rehab rents.
Okay, great. While we're waiting for additional questions, I had a question for all of the panelists today, which is, we've talked about waivers for things like after rehab rents and the use of Chapter 15, and we've talked about prepayment approvals, we've talked about 2530s, we've talked about other waivers, and I was just wondering if you had any advice for the folks in the field who are going to be submitting some of these requests. What are some of the common sources of delay or things that are omitted from some of these requests? Any hints or tips that you could provide to the audience to make these go a little bit more smoothly?
Just make sure when they have the checklist kind of break it down. If it says that if a use agreement goes with the property, make sure you attach the use agreement and send it. The prepayment checklist pretty much tell you what to send in, but a lot of people don't read the checklist and send in the documents that we're requesting. So as long as you follow the checklist, you should be pretty much okay.
Okay, great.
Okay.
As it relates to the 2530 approval process, if an owner has designated a member of the organization to sign on behalf of the entire organization, then that designation or the authorization for that individual to sign on the behalf of the corporation, that should be submitted with the documentation so it won't be delayed.
Okay, great. Anything else folks want to add?
Margaret, very quickly, for the flex waivers, if they're in the field office, you all would follow the format that is established in the Housing Notice 11-05. It would make the process move faster. Be sure to provide us with any and all information that you think that we can use to make a determination and send the recommendation forward. Following the format is critical. It speeds the process. The less questions that we have to come back to you for verification on, the faster the process can move into, and because that waiver has to be approved by the Assistant Secretary for Housing, FHA Commissioner.
Okay, great. Thank you so much. I think we have a couple questions coming in.
Margaret,
Yes.
just to make mention for the Section 8 waiver requests, one of the important things that sometimes doesn't come through is in the cover letter that you have to send to us recommending the waivers, you need to clearly indicate what waivers you're asking for. Sometimes those don't really come through and it's kind of hard to figure them out.
Okay, great. Thank you. I think the next question is more of something for us to follow up on. It says, when will asset management be informed about the changes in the 9807 processing with regards to the tax credit pilot? And I think the reason for this question is that the predominant audience for this broadcast is, of course, the development staff, not necessarily asset management. And I think we'll take that back to asset management and make sure that that gets communicated in a phone call. The next question I think might also be for Stan. It says, does the Section 8 renewal policy for budget rent increase under Option 2 include a line item for debt service coverage? If not, do you permit waivers on a case-by-case basis?
Go ahead, Margaret.
Stan and my favorite topic. So we're laughing because we get this question a lot.
Yes.
And it's clear as mud.
Yes, it's clear as mud. The short answer is that we do, but you need to. That would be an item that that you need to at least highlight to us, because at this point, it's not an issue of waivers, but it's also not clearly in guidance. So you would need to highlight that in the material that you submit to us.
And I would also add that the place where we do have clear guidance on this is in the context of a Section 202 prepayment that includes a Section 8 contract renewal. And if you've seen the most recent guidance for 202 prepayments, there's a frequently asked questions document for Notice 2012-08 that talks about the debt service coverage line item and some guidance for how to look at that. The other place where it's been utilized is in the context of a Section 236 IRP decoupling. So we can definitively say that absolutely, yes, it can be included there. And then otherwise, if you're asking for a waiver and you're including that in part of the waiver request, as Stan said, you'd want to highlight that. So we will be available for follow-up questions. If folks want to provide us with questions, we're happy to do that. But at this time, what I'd like to do is we'll take a quick 5-minute break. When we return, we will switch gears and I will be inviting Kathy Soroka up here from the Office of General Counsel to lead us through a discussion of legal issues. But I'd also like to thank our panel today for your participation. Thanks, and we'll see you in a few minutes. everyone, and welcome back. Thank you for rejoining us for the continuation of our training session here today. I, in a moment, will introduce our next speaker, but before I do that, I just wanted to clarify a point. We got a follow-up question to the assisted housing panel that we just disbanded, and that is a question to clarify something about the rehab limit for this 223F pilot program, and how that relates to the timing of the post-rehab rent increases. So as my colleague Stan Hull mentioned, we do have the ability to approve post-rehab rent increases to take effect at the time of the loan closing of the initial endorsement in the case of a 223F. But if you're familiar with the Section 8 renewal guide, you may know that there is a requirement that the repair limits essentially be set at the typical 223F levels. That is to say, the 6,500 times the high cost factor, that the rents can take effect at initial endorsement, initial/final in the case of a 223F, if the if the repairs are below that 223F threshold. So under the pilot program, because it is a pilot, again, as Stan mentioned, you can request a permission to have those rents take effect at the time of the initial final endorsement. And when you do that, just let us know that it's for the tax credit pilot program, and we will consider that and having those rents take effect at the time of that closing, even if the repairs are up to the 40,000 pilot level. Just wanted to make a note that we know that that does conflict with what's in the renewal guide, but in the spirit of the pilot, we will certainly consider that request. There, I'm sure, will be a number of other technical questions, and we'll be happy to take those as follow-up after today's session. But today, what I'd like to do now is introduce our next guest, Kathy Soroka, who's a Special Assistant in the Office of General Counsel here at HUD. We're delighted to have her expertise here on the pilot, and she'll be talking to us about legal issues related to pilot applications.
Thank you, Margaret. We'll be talking just about a couple points regarding the legal review process and requirements. First, we'll talk about any changes to the process, then we'll talk about any different legal requirements, then finally different legal documentation, and then we'll take any questions that we have. First, in terms of the legal review process, the main takeaway is the sooner the better. We want to involve the HUD attorneys as quickly as possible. The regional council will be assigning local attorneys in each of the project jurisdictions to close the loans. And our hope is to involve those attorneys at the initial concept meeting so that as soon as possible, we can commence legal review with whatever is available, whatever documents are available. Now that includes, as soon as possible, starting to vet title and survey and other long lead items. If in a particular project there's a hairy issue, just like the asset management folks were saying, vet that early, bring that up as soon as possible. Same thing on the legal side. If there's any legal waivers that are required, if there are legal issues that are going to come up, bring them up as soon as possible. Let's not wait until the firm commitment is issued. And that being said, the field counsel are on board with moving forward as quickly as possible. We understand that FHA is making this pilot a priority, and you will, the council have committed to being responsive and to bringing their review up to speed as soon as they get documentation, because we know that we are all working together to accelerate the process, and problems that may have been seen in the past will not be duplicated because of an extended review process. To bring the slides up to date. So covered this one. Now, in terms of the legal review requirements, those are pretty much the same. We did update the 223F checklist to bring in construction-related items and any additional pilot-specific items relating to tax credit requirements. For example, one that comes to mind is that because of the potential increased rehab costs, up to $40,000, housing may require an engineer or an architect to oversee the repairs. So if housing requires an architect, review of whatever housing requires will be added to that checklist. In the same way, because we know that these deals will involve tax credits, review of tax credit specific items will be added to the checklist. But these are not taken new from whole cloth. These are requirements that you've seen in other deals and that reflect the requirements that are in the processing guide. So there's not, shouldn't be anything revolutionary in terms of legal closing requirements. In terms of changes to the legal documentation, this is where we see the most change because of the pilot. But again, because of the initial response to the pilot, we have already brought this documentation into practice. There is the passive investor certification, the document that was formerly known as the LLCI certification, where the passive investors are certifying that they're not taking control of the project. We've already had trainings on this with both field counsel and with housing development staff to bring this document into practice, not just for the pilot, but also for any low-income housing tax credit FHA transactions. This, again, just clarifies and updates the LLCI certificate that was drafted in 2007 to make the language more accurate and make it more user-friendly. As Dan Sullivan will clarify in the mortgage credit review piece, this certification, this passive investor certification, can be used in lieu of 2530s by both syndicators and investors in their investor capacity. If a syndicator were to create a general partner or take control of the project long term, that would require a 2530 that's caught under normal 2530 requirements that the asset management that Eric Ramsey spoke about previously. So again, we've talked about this on national calls. It's the same, and it's continuing to be rolled out. Secondly, the second document is the low-income housing tax credit rider to the security instrument. Again, we've talked about this in the same time that we've talked about the passive investor certification. This initially was rolled out with the pilot to smooth out some of the road bumps that we've traditionally had with low-income housing tax credit and FHA, using those jointly. The rider is very simple. It's posted on the FHA pilot website, and it addresses just a couple of key points. The first is notice to the investor, very simple. The second is transfer of the investor interest, the same as we've just talked about with the passive investor certification. And the third is the pre-approval of the special limited partner. We've also then drafted instructions for the pre-approval process of the special limited partner. As we've discussed, the investors sometimes create an entity that is waiting in the organizational structure of the borrower to take control if the deal starts to go awry. In that case, it's in HUD's interests and the investor's interests to allow the investor to take control and potentially save the project. But we're not circumventing all of our 2530 requirements. We are providing a limited short-term ability for the special limited partner to take control of the project short-term. These pre-approval instructions that are drafted and that are found on the FHA pilot website go through the process, which is basically a modified TPA process. The idea is to do that up front so that at the time the deal goes awry, if it were to do so, then you would not have to go through the TPA process at that point, but the special limited partner would be empowered to move forward immediately and hopefully save the transaction at that point. So that's about it. The other requirements are pretty much the same. The main takeaway is if there's anything you think is going to cause a bump in the road, bring it to your counsel as soon as possible. And if you do have any questions after this webcast, feel free to reach out to me directly if they're questions of a legal manner. And I believe we also are taking questions now.
That's right. If folks have questions, feel free to email us. Again, the email address is mark.c.wiesendanger@hud.gov, and we would be happy to address those questions now. I don't think we have any questions coming in yet, but we certainly appreciate OGC's involvement in the pilot and hope that as we move forward on closings, I'm sure that through the pilot process we'll be able to identify even more areas where we could help to streamline things and develop new tools. And I know that all of your colleagues in OGC are looking to do that. So it doesn't look like we have any questions coming in yet. We'll give it just a moment to see if folks have any issues that they'd like to bring up at this time. Thanks, everyone. We appreciate your participation, and I believe that there's one more session of the tax credit pilot program training, so please tune in for that when it's rescheduled. And thank you so much for your interest and participation in the pilot program. Thanks a lot, Kathy. Take care.